So I want you to imagine you're sitting down to play a friendly game of Monopoly.
Okay. Yeah, I love Monopoly.
Right. So you're playing strategically, you're, saving your cash,
Hmm.
buying up the right properties when it makes sense.
Building those little greenhouses.
Exactly. But then, like halfway through the game, you notice the person who's acting as the banker just reaching under the board.
Uh-oh.
Yeah. And they're secretly printing, I don't know, $1,000 extra just for themselves.
Oh, wow. Yeah, that would definitely cause a fight.
Right. They just casually add it to their stack.
Yeah.
I mean, you'd probably flip the board over.
Totally. I mean, nobody's going to keep playing a game where someone else can just unilaterally dilute the value of your money.
Exactly. You'd refuse to play.
Yeah.
Yet, as our source material today points out, that is literally the exact system we just accept with our real-world bank accounts. Like every single day.
It's wild when you frame it like that because, I mean, that is the defining flaw of traditional finance.
Yeah.
And honestly, it's the exact vulnerability that mathematically constrained digital assets were engineered to solve from the very beginning.
Right.
Like when you strip away the flashing price tickers and, the crazy social media hype.
No noise, basically.
Exactly. When you ignore the noise, what you are actually looking at is a fundamental structural reinvention of how value is measured, enforced, and preserved.
Which is huge. So for you listening right now, our mission today is to really decode that structure. We are doing a deep dive into a newly published article. It's actually dated exactly today, March 25, 2026.
Fresh off the press.
Very fresh. It's by an author who goes by cryptocurrencies on the Normie Crypto platform.
Right.
And it's titled The Math Behind Crypto, Why Fixed Supply Changes Everything.
It's a great piece.
It really is. We are completely stepping away from the market chaos today to look at the cold, hard logic of the supply and demand equation.
Yeah, because we really need to explore why moving from, endless arbitrary fiat money printing to actual mathematically fixed scarcity completely rewrites all the rules of investing.
It changes the whole game.
It really does, because for an audience that's already familiar with the broad strokes of digital assets, the conversation has to move beyond just saying, oh, Bitcoin has a supply cap.
Right. We all know that part by now.
Exactly. The real insight here lies in the mechanics, things like relative supply ratios or the tokenomics of really aggressive burn rates.
Oh, yeah. The burn rates get crazy.
Totally. And how liquidity dynamics actually dictate market movements. I mean, we aren't looking at random speculation here. We are analyzing pure, unyielding math.
Okay, let's unpack this. Because the article uses traditional fiat inflation as its baseline, right?
Which, unfortunately, we all know way too well.
Oh, definitely. Central banks just inflate the total supply of currency in circulation, and it quietly reduces the purchasing power of the money sitting right in your wallet.
It's basically an invisible tax.
Exactly, an invisible tax. But cryptomishi pivots pretty quickly to what they call mathematically constrained systems.
Yes.
So for someone who already understands that crypto is decentralized, what is the actual mechanism making that constraint, like an ironclad reality?
Well, so the mechanism is basically the consensus layer of the code itself.
Oh, right.
In a true mathematically constrained system, the supply schedule is completely transparent. It is hard-coded from the Genesis block.
And the Genesis block, that's just the very first block of data, right?
Exactly. The absolute very first block that kicks off the entire network. The rules are set right there, and they are strictly enforced by a distributed network of thousands of independent nodes.
So a bunch of computers constantly checking each other's work.
Spot on. And because of that, no CEO, no president, no rogue developer can just wake up tomorrow and push an update to quote-unquote print more.
They can't just reach under the Monopoly board.
Right. If they even try, the network simply rejects their version of the ledger as completely invalid. It really is decentralization in its absolute purest form. It relies entirely on cryptographic verification instead of, the whims of human authority.
That makes so much sense. And that brings us to the actual numbers, which is where the article really gets into these comparative structures.
The math gets fun here.
It does. Cryptoshe lists out the hard caps programmed into a few of the major networks. So Bitcoin is famously locked at a maximum of 21 million coins. Ever.
Never going to be more than 21 million.
Right. Then you have Litecoin, which was created shortly after, and that established a hard cap of 84 million coins.
Yep.
And then further out on the spectrum, you have projects like Digibyte, which maxes out at a massive 21 billion coins.
So what's fascinating here is how these relative supply levels create a framework for comparative evaluation.
What do you mean by that?
Well, the article introduces this concept called the supply ratio.
Okay.
Because think about it, Litecoin's cap is 84 million and Bitcoin's is 21 million. So there is exactly a 4-to-1 ratio in their total potential supply.
Okay. Just basic division.
Right. Roughly 4 Litecoin equals 1 Bitcoin, strictly in terms of how mathematically scarce they are relative to one another.
Got it. And with Digibyte sitting at that huge 21 billion cap, the ratio is 1,000 to 1 compared to Bitcoin.
Exactly.
But wait, I have to jump in here and push back on the premise a little.
Going for it.
Cryptocurrency lays out these ratios beautifully. The math is clean. But does that mean a coin's actual dollar price must perfectly match its supply ratio in the open market?
Oh, I see where you're going.
Right, because if Bitcoin is trading at $100,000, the math dictates that a 4-to-1 scarcity ratio should price Litecoin at exactly $25,000.
Yeah.
But anyone looking at a chart knows that just isn't the reality at all.
Yeah.
So isn't the whole supply ratio thing just kind of a theoretical exercise?
It's an important distinction to make for sure. And to be fair, the source material doesn't actually claim that prices will perfectly align with supply ratios.
Okay.
Because, markets are ultimately driven by demand, network security, developer activity, utility, not just supply.
Right. There are a lot of variables.
Exactly. However, the supply ratio acts as this really critical baseline for spotting fundamental undervaluation.
Oh, interesting.
Yeah. So if you're analyzing 2 networks that offer similar utility or, say, similar transaction speeds, but one is trading at a massive, massive discount relative to its mathematical supply ratio against the market leader.
Then you might have found an opportunity.
Precisely. It highlights a potential asymmetric upside. It basically gives you a mathematical framework to evaluate risk rather than just guessing which coin might go up because of a meme or whatever.
Here's where it gets really interesting, though, because understanding those much larger supply caps like Digibyte's 21 billion, it actually explains this massive phenomenon in retail investing.
Oh, the power of 1-0.
Yes.
Yep.
CryptoKishi calls it the power of 1-0. The premise is that when a coin has a much larger fixed supply, like billions instead of millions,
Right.
the price per individual coin naturally just sits a lot lower.
Yeah.
Might trade for pennies or even fractions of a penny.
Yep, very common.
And the article suggests that adding a single zero to the price, going from 1 cent to 10 cents, is this massive 10x gain that is somehow uniquely accessible to these lower-priced coins.
And psychologically, human beings just love that.
They really do.
They would much, much rather own 50,000 whole units of an asset than like 0.005 of a single Bitcoin.
Oh, absolutely.
Even if the dollar value is exactly the same, it just feels like you hold a much more substantial position.
I have to stop you there, though, because honestly, that sounds like a massive psychological trap.
How so?
Well, just because a coin is priced at a penny, that doesn't mean it magically has an easier time getting to a dime.
Fair point.
Like, if a coin has a massive circulating supply, its total market capitalization might already be in the billions of dollars. So doesn't the power of 1-0 actively trick retail investors into completely ignoring market cap?
That is a brilliant pushback. Seriously, it highlights a nuance that even seasoned investors get wrong all the time.
Really?
Oh, yeah. You are absolutely right that the unit price of a coin is completely irrelevant if you don't know the circulating supply.
Right. It's only half the equation.
Exactly. Market capitalization, which is just the current price multiplied by the total circulating supply, that is the only true metric of a network's actual financial size.
Okay.
So if a coin costs 1 single penny, but there are 1 trillion tokens in circulation, its market cap is already $10 billion.
Which is huge.
It's massive.
Yeah.
So for that penny coin to reach 10 cents to get that 10x gain, it literally requires an injection of tens of billions of dollars in new capital.
Exactly. It's not just quote-unquote adding a zero. It's moving an absolute mountain of liquidity.
Precisely. However, there is a catch where Cryptoshi's math actually holds weight.
Okay, I'm listening.
It works when you look at order book depth and liquidity. If you find a mathematically constrained asset that has a low unit price, but it also has a legitimately low total market cap,
Then what happens?
the liquidity required to move the price is significantly smaller. Think about traditional markets. Finding a stock that multiplies by 10, that takes years of flawless corporate execution and massive institutional capital.
Yeah, that almost never happens quickly.
Right. But in a thinly traded digital asset with a fixed supply, a sudden influx of global retail demand hits an order book that just simply doesn't have enough sellers to absorb the volume.
Oh, I see. It's like an auction for the absolute last remaining ticket to the Super Bowl.
Yes.
The stadium seats are totally fixed. It's an inelastic supply.
Yeah.
As more and more fans start bidding, the stadium doesn't magically get any bigger to accommodate them all.
It can't.
So the price of that single remaining ticket is just violently forced upward.
That is the perfect analogy. And it actually perfectly transitions into the next major evolution of this math that the article talks about.
Oh, the burn mechanisms.
Right. We've been discussing systems where the supply is permanently fixed from the start. The stadium seats never change.
Yeah.
But what happens to the market dynamics when a project actively and deliberately destroys its own supply over time?
Yeah, this is the hyperscarcity section of the article.
Mhm.
It is fascinating. Cryptocurrency introduces this concept of the burn mechanism.
It's a game changer.
It really is. They highlight a specific example, too. The me-linked MK token, which they note operates as an ERC-20 token.
Right.
And apparently the developers behind this project initiated a protocol that has already burned over 90% of its total supply.
90%. I mean, that is a radical approach to tokenomics. They are taking the concept of finite scarcity and just aggressively accelerating it.
Wait, before we move on, I want to clarify something. The article specifically notes Meme-linked MK is an ERC-20 token. For you listening, why does that specific token standard even matter when we're talking about verifiable burn mechanisms?
That's a really good question.
Like, what is actually happening under the hood when a token is quote-unquote burned?
So that technical detail is actually crucial. ERC-20 is the technical standard for smart contracts on the Ethereum blockchain.
Okay.
And a smart contract is essentially just self-executing code. So when we talk about burning tokens in this specific context, we aren't talking about, a company promising to delete some files on a private server somewhere.
Like we just have to trust them.
Right, no trust required here. We are talking about interacting with a decentralized smart contract that permanently routes those tokens to a verifiably dead wallet address.
Wow. So it's literally a cryptographic black hole.
Exactly. That's exactly what it is. A common burn address usually looks something like 0x, followed by a long string of zeros, and then the word dead at the end.
Dead. Nice and subtle.
Right. And because of the fundamental laws of cryptography, we know with absolute mathematical certainty that the private keys required to unlock that specific address just simply do not exist.
They're gone.
They never existed.
Yeah.
Any token sent to that address is permanently removed from the circulating supply equation. No one can ever retrieve it, sell it, or spend it.
So if we connect this to the bigger picture,
Yeah.
burning 90% of the supply creates a far more aggressive scarcity dynamic than just a standard fixed supply,
Dramatically more.
because it actively compresses the timeline for potential gains, right?
Mm.
Since every single remaining token inherently carries vastly more weight within the ecosystem's market cap.
It dramatically alters that liquidity profile we were just discussing with the Super Bowl tickets.
What, right?
Because if you permanently remove 90% of the sellable assets from the order books, the remaining circulating supply becomes hypersensitive to incoming capital.
Order books are super thin.
Exactly. It takes exponentially less buying pressure to trigger those outsized high multiple price moves. The math basically dictates that a fiercely shrinking number of tokens, combined with steady or increasing market demand, results in a violently amplified price trajectory.
Okay, so what does this all mean? I want to challenge the premise one more time.
Hit me.
Because the math on paper is elegant. It's beautiful. But it doesn't operate in a vacuum. You can burn 99% of a token supply. You can mathematically compress it until it's the absolute rarest digital asset on Earth.
Yeah.
But if nobody knows it exists, or if nobody actually wants to buy it, the price isn't going anywhere.
Nope. Not moving an inch.
Right. It still requires that vital second half of the equation, actual awareness and growing adoption to trigger those moves, doesn't it?
You've literally hit on the fundamental truth of all markets right there. Scarcity alone does not equal value.
It doesn't.
I mean, I could draw a stick figure on a napkin right now, declare it the only one in existence, and securely lock it in a steel vault.
I'd probably buy it, but go on.
Well, it has absolute, verifiably fixed scarcity, all right?
Right.
But objectively, it is entirely worthless because there is zero global demand for it.
Exactly. The burn mechanism perfects the supply side of the equation.
Yeah.
It sets the stage beautifully. But the explosive potential that the article outlines, it only actually detonates when that tightly compressed supply intersects with a rising tide of new users. The awareness is what drives the demand against that fixed supply.
And that right there is the delicate balance of navigating the entire crypto space.
Really?
Yeah, you are basically looking for assets that have proven their mathematical constraint, either through fixed caps or verifiable burn contracts, while simultaneously demonstrating growing network adoption.
Right.
Because when those two specific forces collide, the price discovery can be incredibly aggressive.
And that really brings us to the core thesis of Crypto Initi's article, and I think the main takeaway for you today. This deep dive, it isn't about giving you a list of tokens to buy or chasing the latest internet trend.
No, not at all.
It is fundamentally about shifting how you view the entire architecture of money itself.
Because we have all been conditioned to accept a financial reality where the tape measure is constantly being stretched by central authorities, where the actual purchasing power of your hard labor is slowly diluted just to service massive macroeconomic debts.
But understanding the math behind fixed supply and these hyper-deflationary assets, it offers an entirely different framework.
It really does.
You aren't just speculating on a digital coin, you're opting into a finite system. In a world where traditional fiat can just be endlessly inflated until the paper it's printed on is functionally worthless.
Yeah.
Understanding this math might truly be one of the most vital financial shifts you can make. Is a profound transition from trusting fallible human institutions to trusting immutable equations. As the article states, welcome to the math game.
Welcome to the math game. I love that. And, as you navigate this mathematical landscape, this raises an important question for you to consider long after this discussion ends.
Oh, I like this. Lay it on us.
Well, we've established how value is driven by the collision of demand and pure verifiable scarcity.
Right.
But if we are moving toward a future where protocols actively and aggressively burn their supplies down to a tiny fraction, and simultaneously the vast majority of those remaining assets are pulled off exchanges and permanently locked away in cold storage, offline wallets by absolute long-term believers.
Okay, I see where this is going.
What happens to the mechanics of global economics? What actually happens when a highly demanded, globally recognized digital asset achieves functionally zero circulating supply for new buyers?
Wow. A completely locked down, hyper-scarce financial future where the order books are entirely empty.
It's intense math.
That is definitely something to chew on. Well, thank you so much for joining us and taking this deep dive into the math behind the movement. We'll catch you on the next one.